Level 1, $0 to 1 million. This is where 98% of people quit before they even understand what they were playing. Here's the part nobody tells you. The empire doesn't start with a mansion or a mentor or $1 million check from a rich uncle. It starts in a spreadsheet at midnight, staring at a number that refuses to move no matter how many lattes you skip. You've heard the math 100 times. 20% down on a $300,000 house is $60,000 cash, sitting in a savings account earning nothing while rent eats you alive every month you don't have it. At that pace, saving $500 a month, you're looking at a decade before you even qualify to play the game. Most people stop right there. They assume the front door is the only door. It isn't. You find out about house hacking the way most people do, buried in a forum thread at 1 a.m., written by someone who sounds too calm about the math to be lying. An FHA loan lets you buy a property with as little as 3.5% down. Not 20, 3.5, on a $300,000 fourplex. That's $10,500 instead of $60,000. The catch, and there's always a catch, is that you have to live in one of the units for at least a year. So you do. You move into the smallest unit, the one with the water stain on the ceiling nobody's bothered to fix, and you rent out the other three. Suddenly your mortgage isn't a bill you're praying to survive. It's a number your tenants are paying down for you, unit by unit, month by month, while you sleep 15 feet away from your first asset. This is the mechanic almost nobody outside real estate understands. You didn't need to save six figures. You needed to find a lender willing to bet on you at 3.5% and a property with enough units to cover its own mortgage. That's the cheat code. Not illegal, not even hidden. Just ignored by everyone still grinding toward that 20% number that never actually mattered. Your first tenant is a nurse named Odalise who works nights and pays on the first of the month like clockwork. And your second tenant is a guy who calls you at 11 p.m. because his garbage disposal is making a noise. You learn landlording the way everyone actually learns it. Badly, then better. You learn that a $200 plumber bill you could have fixed yourself with a $9 YouTube tutorial and a wrench is a tax on not knowing yet. You learn to screen tenants after the first one stops paying in month 4, and you spend 6 weeks in a legal process you didn't know existed, filing paperwork at a courthouse that closes at 4:30 on weekdays like it's daring you to have a job. You learn what a security deposit is actually for. You learn the word eviction isn't a threat. It's a 9-week process with its own vocabulary. None of this is glamorous. None of it makes a good thumbnail. But every mistake here is tuition, and the tuition at level 1 is cheap compared to what the same mistake costs at level 3, when the number attached to it has 2 more zeros. Here's where the game actually branches. The version of you that spends the rental income, the $600 a month in positive cash flow after the mortgage, the insurance, the vacancy reserve, stays at level 1 forever. Maybe upgrades a car. Maybe finally gets those new shoes. The version of you that treats that $600 as ammunition, not income, starts stacking it in a separate account nobody touches. 18 months later, that account has enough sitting in it, combined with the equity your tenants have been quietly paying down, to qualify for a second FHA adjacent loan or a conventional loan on a small multifamily. You do it again, then a third time. You're not buying one house at a time anymore. You're buying access, one property teaching you enough to qualify for the next. This is also exactly where most people blow themselves up, and it's worth naming the mistake before you make it instead of after. Over-leveraging looks like ambition until the roof needs replacing and you don't have $14,000 sitting anywhere because every dollar you own is locked into down payments on 3 properties bought in the same 8-month window. The other version of the mistake is buying the wrong first property entirely. The turnkey single family in a hot neighborhood that cash flows $40 a month if nothing ever breaks, bought because it looked good in photos, not because the numbers survived a bad year. A property that cash flows $40 a month has a rounding error for a safety margin. One slow month, one bad tenant, and you're paying to own it instead of the other way around. The people who actually reach $1 million in assets by the end of level 1 aren't the ones who moved fastest. They're the ones who ran the numbers on every deal like the deal was trying to lie to them, because it usually is. They bought boring properties in boring neighborhoods with boring, predictable cash flow, and they left the boring version of themselves in place long enough for the math to compound. $1 million in real estate at this stage doesn't look like wealth. It still looks like a guy answering his own maintenance calls at 11 p.m. It looks like Odalise still paying rent on the first, like a spreadsheet still open on your laptop, like equity quietly stacking in the background while nobody's watching. That's the part that separates level 1 from every level after it. You're not managing money yet, you're still managing yourself. And whether you make it to level 2 depends entirely on whether you can stay boring long enough for the boring thing to work. Level 2, 1 million to 10 million. The rules change the second you cross the line, and nobody hands you the new rulebook. You're still thinking like a saver. That's the first thing that has to die. You've got 4 doors now, maybe 5, cash flowing a combined $2,200 a month after everything, and equity sitting quietly in properties that have appreciated while you weren't looking. Here's the number that changes everything. Your first fourplex bought for $300,000, appraises 3 years later at $410,000. You didn't do anything to earn that $110,000 except hold it and pay down a mortgage with someone else's rent money. But it's dead equity, sitting there, doing nothing, until you learn the word that unlocks level 2. Refinance. This is the BRRRR strategy, and once you understand it, you stop seeing houses and start seeing machines. Buy, rehab, rent, refinance, repeat. You find a duplex that needs work ugly enough that nobody else wants it. Listed at $180,000 in a neighborhood where fixed-up comps sell for $260,000. You buy it with a hard money loan, ugly interest rate, 12%, but only for 6 months. You put $40,000 into it, new roof, new kitchens, new everything a tenant will actually pay for. You rent both units for a combined $2,600 a month. Then you walk into a bank with an appraisal that comes back at $270,000 and you refinance into a conventional loan at 75% loan to value. That's $202,500. You pay off the hard money loan and the rehab costs, and you walk away from the closing table with most of your original capital back in your account, still owning the property, still collecting the rent. You just bought a cash-flowing duplex with almost none of your own money left inside it. That's not a loophole, that's the entire game at this level. Equity isn't wealth you look at anymore. It's ammunition you pull back out and fire again. You stop buying single-family homes around here too. And there's a cold, boring reason why. 1 unit down is 100% vacancy. 1 unit down in a fourplex is 25% vacancy, and the other 3 are still paying your mortgage while you find a new tenant. Small multifamily, 8 units, 12 units, 16 units, becomes the whole focus because the math scales faster per transaction. 1 closing, 1 inspection, 1 loan, 16 doors instead of 16 separate headaches spread across 16 separate deals. You start hunting in the 10 to 50 unit range specifically because it's too big for most individual buyers and too small for the institutional money that shows up later at level 3. That gap is where you live now. But you physically cannot do this alone anymore, and that's the part that breaks people who try to stay a one-man operation past level 1. You hire your first property manager, a woman named Corinne, who used to run leasing for a regional apartment group, and you pay her 8% of collected rent to stop being the person who answers a 2 a.m. call about a broken water heater. You build a relationship with a general contractor named Marcus who you use on every single rehab now instead of shopping around each time, because a contractor who trusts your check clearing gives you better bids and faster timelines than a stranger ever will. And you build the relationship that actually matters most, a local portfolio lender named Theo who understands what you're doing well enough to underwrite you as a business instead of underwriting each house as an isolated event. Theo is the reason the 3rd and 4th BRRR deals close in weeks instead of months. Somewhere around your 7th or 8th property, you run into a wall that pure BRRRR can't solve by itself. You find a 16-unit building, a real one, $1.4 million, that cash flows beautifully on paper but needs $250,000 down. You don't have $250,000. This is where you meet the second unlock of level 2. Other people's money. You find a dentist named Priyanka, not the same Priya, a different one, who has $300,000 sitting in a money market account earning nothing and 0 interest in ever fixing a toilet. You structure a deal. She brings the capital, you bring the sourcing, the underwriting, the operations. She gets 8% preferred return and 30% equity in the deal. You get the rest, plus a fee for running it. Neither of you could have done this alone. Together, you own a 16-unit apartment building neither of you could have financed solo. This is also exactly where the game gets dangerous, and it's worth saying plainly before it happens to you instead of after. Cash flow crunches don't announce themselves. They creep in through 5 deals closing in the same 90-day window because every one of them looked good individually and nobody stopped to add up the combined reserve requirement. You do the math too late once on a spreadsheet at midnight again, same as level 1, except the number this time isn't 60,000, it's a $40,000 roof on one property landing the same month as a $30,000 vacancy stretch on another, and your reserves are sitting at $18,000 because every dollar you had went into down payments chasing speed instead of safety. You learn the expensive way or the cheap way depending on how lucky you get. That leverage cuts in both directions at the exact same speed. The operators who actually make it to 10 million by the end of this level aren't the ones who did the most deals the fastest. They're the ones who kept 6 months of reserves sitting untouched across the whole portfolio, even while every instinct screamed to deploy that cash into the next acquisition. You start understanding, standing in front of a 16-unit building with someone else's $300,000 inside it, that scaling with leverage only works for people disciplined enough to leave some leverage on the table. Level 3. 10 million to 100 million. This is where the game stops being about your money entirely, and that sentence should scare you a little before it excites you. You've got the 16-unit building with Priyanka's money in it, cash flowing, refinanced twice, and you're staring at a 44-unit deal in a growing submarket that needs $2.8 million down. You don't have $2.8 million. You'll never have $2.8 million sitting around waiting for a deal. Not at this level, not ever, because the deals scale faster than any single person's balance sheet can follow. This is the moment you stop being an investor and start becoming a sponsor. You're not buying real estate anymore. You're raising capital to buy real estate, and those are two entirely different businesses wearing the same suit. You learn the letters before you learn anything else. GP and LP, general partner, limited partner. You're the GP now, the one who finds the deal, underwrites it, signs on the loan, and operates the asset day to day. Your investors are LPs, people who write checks and never touch a toilet, never talk to a tenant, never see the property except in a quarterly PDF. The structure that makes this work, the one you'll use for the next decade, looks something like this. Investors put in 80% of the equity. You put in the remaining 20, sometimes less, sometimes none if your track record is strong enough. They get a preferred return first, 7 or 8% annually, before you see a dime of profit above your acquisition fee. After that preferred return is paid, profits split 70-30 in the investor's favor up to a certain return threshold, then 60-40, then 50-50 once returns cross something like a 15% internal rate of return. You also collect an acquisition fee upfront, 1 to 2% of purchase price, just for finding and closing the deal, whether it ever makes a dollar for anyone or not. That fee is the thing that keeps the lights on while the property matures. You leave small multifamily behind almost entirely now. 10 and 16-unit buildings were the right size for level 2. They're the wrong size for this level, too small to justify the overhead of a syndication, too small for the institutional debt you're about to start using. You move into true commercial, a 144-unit apartment complex outside Charlotte for $18 million. An industrial flex park in a secondary market for $12 million, 6 buildings, 22 tenants, triple net leases where they pay the taxes, insurance, and maintenance, and you just collect the check. A half-vacant office building you buy at a steep discount because everyone else is scared of office space in this decade, and you convert half of it to medical suites because a hospital system needs overflow space, and will sign a 15-year lease at rates residential could never touch. This is also where the 1031 exchange stops being a tax strategy you read about and becomes a tool you use every single year. You sell the fourplex from level 1, the one that started everything, for $410,000, and instead of paying capital gains on the appreciation, you roll every dollar of it into the down payment on the industrial park, tax deferred, as long as you identify the replacement property within 45 days and close within 180. You do this again 18 months later, selling the 16-unit building for a $600,000 gain and rolling it straight into the office conversion. You're not cashing out, you're trading up, tax-free, every single time, and the IRS lets you do it indefinitely as long as you keep buying bigger. None of this survives on instinct anymore either. At level 1, you underwrote deals on a napkin. At level 2, you had a spreadsheet. Here, you build a team because an $18 million mistake doesn't forgive you the way a $40,000 mistake did. You hire an acquisitions analyst named Renata straight out of a REIT's underwriting desk, and she builds you a model that stress tests every deal against a recession scenario before you ever make an offer. You hire an asset manager, Colton, whose entire job is walking properties, reading rent rolls, and catching the small operational leaks before they become the reason a deal implodes. You build an actual investor relations process, quarterly reports, a portal, a real PPM drafted by a securities attorney, because raising money from more than a handful of people without proper documentation isn't a gray area anymore. It's the SEC's entire job to find you. And this is exactly where the level 3 mistake lives, the one that ends careers instead of just bank accounts. You watch it happen to a sponsor named Garrett Lowe, 2 towns over, who raised $9 million from 40 investors for a value-add apartment deal and told every single one of them to expect 14% annual returns starting month 1. Interest rates moved, his refinance fell through. The renovation ran 9 months over schedule. He kept sending investors upbeat updates instead of the truth, because admitting the number had changed felt worse than delaying it. By the time he finally disclosed the shortfall, 3 investors had already told their friends about the 14%, and those friends had wired money into round 2 based on round 1's promise. The lawsuits took less time to arrive than the drywall repairs did. You don't forget that story. Overpromising a return you can't guarantee isn't optimism at this level. It's the fastest way to turn other people's retirement accounts into your personal liability. Level 4, $100 to $500 million. Garrett's story is the last one that happens to you personally. From here on, the mistakes happen to entities with your name attached to them, not to you directly, and that distinction is the entire game now. You've got 3 funds under management by the time you cross $100 million. The Charlotte apartment complex, the industrial flex park, the office conversion, plus 11 other properties you've picked up since, scattered across 4 states, 4 different asset classes. And that scatter isn't an accident anymore. It's the whole strategy. At level 3, concentration was fine because you could still walk every property yourself, know every roof, every tenant, every market quirk. At this level, concentration is how a single regional recession wipes out half your net worth in a fiscal quarter. You watch it almost happen to a fund 2 tiers above yours, 90% multifamily, 90% Sun Belt, when a single metro's job market cratered after a corporate headquarters relocation, and every asset in the portfolio bled occupancy at the same time in the same month for the same reason. You don't build that fund, you build the opposite one. Multifamily in Austin, industrial in Columbus, a medical office portfolio in Tampa, a self-storage platform in 3 Midwest markets nobody's competing for yet. Different asset classes respond to different economic pressures at different times, and that mismatch, the thing that used to feel like inefficiency, is now the only insurance policy that actually works. The money changes shape too. You're not calling 40 individual LPs anymore, chasing checks from dentists and Priya's college friend group. You're in a room with a pension fund allocator from a state teacher's retirement system who controls $60 billion and needs to place $40 million of it into real estate this quarter alone. Whether your deal exists or not, just to hit an allocation target set by an actuary who's never seen a building in person. You're talking to a family office representing 3 generations of a beverage distribution fortune, people who move slower than institutions but ask sharper questions because it's not a spreadsheet to them, it's Thanksgiving dinner if it goes wrong. You're fielding calls from a private equity shop that wants to co-invest alongside you on a $70 million acquisition because your operational track record is worth more to them than their own capital deployment team's time. Institutional money doesn't care about your story. It cares about your Sharpe ratio, your loss history, your audited financials going back 5 years, and whether your asset manager, the Colton you hired at level 3, has since built out an entire regional operations team that doesn't blink when a $30,000 roof repair becomes a $300,000 structural issue mid-renovation. This is also where you stop raising deal by deal and start raising a fund. A blind pool, technically, though nothing about the underwriting behind it is blind. You raise $150 million into a discretionary fund with a defined investment thesis, value-add industrial and medical office in secondary Sun Belt markets, and investors commit capital upfront without knowing which specific properties you'll buy with it. They're betting on you now, not on a deal memo. You take a 2% annual management fee on committed capital, whether that capital is deployed or sitting in a money market account waiting for the right acquisition, plus a 20% carried interest above an 8% preferred return. The same waterfall math you learned at level 3, just with 3 more zeros attached and a securities attorney on retainer instead of on speed dial. Some of your properties you migrate into a REIT structure entirely non-traded, which lets smaller accredited investors buy shares instead of committing to a single illiquid deal, and gives you a permanent capital vehicle that never needs to be refinanced or sold on someone else's timeline. And then exits stop being one thing. At level 2, you sold or you didn't. Here you architect. You take the entire industrial portfolio, 11 buildings across 3 states, and sell it as one package to an institutional buyer who pays a premium for the scale itself, for not having to assemble 11 separate deals on their own. You recapitalize the apartment portfolio instead of selling it, bringing in a new equity partner who cashes out your original investors at a strong return while you retain operational control and a smaller ongoing stake, resetting the clock on the asset without ever losing the relationship you built with the tenants and the market. And some properties you simply never sell. The medical office portfolio in Tampa, cash flowing at 9% with 15-year leases to a hospital system that isn't going anywhere, becomes a permanent hold, the thing you pass down instead of the thing you flip, because at this size, the tax bill on selling something that good is bigger than most people's entire net worth. Here's the truth sitting underneath every level you've climbed so far: the fourplex, the 16-unit, the syndication, the fund. Nobody levels up by keeping their profit. Every dollar you pulled out and spent along the way is a door that closed permanently. Every dollar you reinvested into the next down payment, the next hire, the next fund, is the only reason you're standing here at all. And the risk never goes away, it just changes its name at every stage. And here's the mistake hiding inside this exact level, the one that doesn't show up on a balance sheet for 12 to 18 months. Cross-collateralizing your fund's properties against a single institutional credit facility feels efficient right up until one underperforming asset triggers a cross-default clause and freezes your entire portfolio's financing overnight, not just the property that failed. Sponsors have lost fund control over language buried in a single loan document nobody renegotiated line by line. How you structure debt at this level is worth more than how you find deals. That's exactly what the book linked in the description walks through, deal by deal, clause by clause. Go read it before you sign anything this size.